Okay, it's the Wall Street crossover show with Darren Sinden, market commentator at Admiral Markets, the usual or the permanent pundit on this part of the program or this part of the day. What are we looking at today?
Well, it's obviously the FOMC day, Zach. You know, the Federal Reserve's going to make its latest pronouncement on interest rates, and so that's the major data point. Notwithstanding anything we might hear about Greece, there's a fair bit of interesting European data as well to look at. So if we
okay, let's get into it.
Yeah. So the data released over the European session. First of all, for watchers of the UK, our own Monetary Policy Committee minutes for June were released this morning around 8:30. They showed that the committee voted 9-0 for no change to interest rates and QE in June. As with the last 2 months, though, two members of the committee said that they were finally balanced on their decision, and hard on the heels of the MPC minutes was some data from the Office of National Statistics, and their UK average weekly earnings number. It's quite odd because they measure this over sort of a 2-month period. But anyway, February to April, year on year, is the measure that we're looking at here. The figure came in at 2.7% gain. I think that was well ahead of the forecast of around plus 2.1. It's the fastest rate of growth in wages in the UK since February 2009.
So things finally changing.
Well, yeah. I mean, this is one data point. So I think we'll probably need to see a couple more positive reads on wage growth. But it would suggest, wouldn't it, that if we're going to see continuance of wage growth like that, inflation could come back, and we could be looking at a rate rise in the early part of 2016. And that's the view the markets took. Cable spiked quite sharply on that data.
So in other words, earnings are actually a better indication of interest rates than inflation.
I think that's probably true for now, because of the dynamics of the way that UK inflation numbers are calculated and the market forces that are driving prices down. Yeah, wages probably are a better guide for now. And then in terms of Europe, more traditional measure of inflation there was CPI for May. Year on year, the figure there, and as second read, this is, by the way, for that number, just to sort of confirm it, but 0.3% was the gain. The forecast was 0.3%, and the prior read was plus 0.3%. So a small sign of inflation in the Eurozone, but it's flatlining really across the last couple of months. And so